What's up, family? This is your boy Ivan Hall, the Credit King. Have you ever wondered what is a credit line, and how it works? Let's start with the possibilities available to you when you need to borrow money. Generally speaking, you can apply for either a loan or a credit line. When you take out a loan, you are given a lump sum of money, and must begin paying interest right away, regardless of when you spend it. A line of credit, on the other hand, offers you access to a specific amount of money that you may borrow as needed. However, you do not have to pay interest unless you take out a loan. Personal lines of credit are normally unsecured, which means you don't have to put up any collateral to get one. Secured lines of credit are secured loans that are backed by assets such as your home or a savings account. Better credit scores may help you qualify for a lower annual percentage rate when applying for a line of credit. Some credit cards have fees, such as an annual fee, and limits on how much you can borrow. After you've been approved for the line of credit, you'll be given a draw period during which you can withdraw funds from the account. A draw phase might last a long time. When you're ready to borrow money, the bank may issue you special checks or a card, or transfer the funds to your checking account. When you borrow money from your line of credit, interest will begin to accumulate, and you'll be required to begin making minimum payments, the amount of which will be added back to your available line of credit as you make them. When your draw period is up, you'll enter the repayment period, which will provide you with a certain amount of time to pay off any outstanding balance. Keep in mind that making only minimum payments may end up costing you more in the long run in terms of interest. The lender may do a hard inquiry on your credit reports as part of the application procedure for a line of credit. It's possible that your credit scores will drop a few points as a result of this. When you're accepted and accept the line of credit, it usually shows up as a new account on your credit reports. It is possible to minimize your credit usage rate and boost your credit scores, if you never utilize your available credit or just use a small fraction of the total amount available. At any one time, your usage rate indicates how much of your available credit you're utilizing. If you borrow a large percentage of the available credit, your usage rate will rise, lowering your credit score. In addition, if you make late payments, your credit score may decrease. If you need a secured line of credit, a home equity line of credit, or HELOC, is one alternative. HELOCs allow you to borrow money against the value of your property, and use it as collateral for a line of credit. They usually have a variable interest rate, which means that your payments may go up over time. The bank will usually limit the amount you can borrow up to 85% of the assessed value of your house, less the debt on your first mortgage. Other characteristics, like your credit history and income, are considered by banks when determining your interest rate. If you don't own a property and don't want to put your house up as collateral, you might be able to get a line of credit secured by a savings account or certificate of deposit. What are the drawbacks of a secured line of credit? If you default on your payments, the lender may seize the collateral that secured the loan. If you default on an unsecured line of credit, you may not lose your house or money. However, with unsecured loans, the lender is taking on more risk, which might result in higher interest rates than with a secured line. Determine which product works for your best and go get that money.